We continue with our discussion on Unit 5 of Financial Reporting and Analysis. And we were looking at the importance of cash flows and how do cash flows really become important in the overall analysis of the financial statements of a company. We are now going to look at how does cash flow actually get constructed, right? So what are the steps in the construction of the cash flow? And in the process of these steps in the construction of the cash flow, we will also realize the importance of certain items on the financials of the company, right? So if a certain number goes up or a certain number goes down, what does it mean to the overall financial stability, business strength of the company? That will become evident after this bit, right? So let's understand. Uh, we will first look at how do we create a cash flow statement. So step one is determine the net cash flow from operating activities. So using the income statement and information on current assets and current liabilities from the comparative balance sheets. Now note we had said that operating activities is the P&L part. This is the investing is the assets part, and financing is the liabilities part. However, investing is long-term assets and financing is long-term liabilities. Current assets and current liabilities, the adjustments we will see will come for operating activities. We're going to take a look at that in a few moments as to how that comes under current assets and current liabilities and how does that change impact the operating income, right? Then we find the include summary of any increase or decrease in cash, cash at the beginning of the year, cash at the end of the year, and we disclose any significant non-cash transactions separately at the bottom of the statement. Why do we do that? Is because let's say a company just gives away, a factory without taking a cash transaction, that still has to be reported because technically that's gone out, right? And there is no cash inflow that has been recorded because of that. So if there are any such significant non-cash transactions in certain kind of accounting geographies, they have to be disclosed. Typically, you would not encounter too many of these. These are anomalies as such, right? Let's look at the methods of creating. So you could either have what is called as an indirect method and you could have a direct method. Let's start with the first one, which is the direct method. Direct method usually starts with all inflows and subtracts all outflows. Cash from operating activities, if you're doing that, takes only cash sales. So you basically, when you're creating a direct uh, format of CF operating income, you just say cash sales minus cash expenses, right? Not the total sales and total expenses, but only the cash sales and expenses, and that then you get the cash from ops essentially. And then you carry on with the cash from investing and financing cash flows as well. So that's typically the direct method that is there. Most companies, however, use something else which is called as the indirect method. Right now, what is the indirect method? Under the indirect method, we start first with the net profit as the beginning item. So you start with net profit and then you make adjustments, right? When you start with net profit, what is net profit? Net profit is sales minus all costs. That's what net profit is. So when you start with net profit, you basically make an assumption that all your sales have been received, right? Your first assumption is all sales have been realized and all costs have been paid. If there is any adjustment that is there, so the assumptions are all sales have been paid for and all expenses have been settled, right? Now we start making adjustments to this by removing the sales that are not yet received. What are these? These are the receivables and expenses that have not been paid, which are payables. So this you don't remove, you add the expenses that have not been paid because you've already assumed that that's gone out, right? We are thus making adjustments to the transactions that affect net income but are not cash transactions. You also make adjustments for the non-cash entries, right? Non-cash entries. Let's try and gauge this. When you're doing the indirect method, let's say there is a company where sales is, let's say 1,000, costs are 500, all costs, let's say, or let's say operating costs are 500, then you have depreciation, which is 100, and you have some tax which comes on 400, and let's call the tax also as 100. So you're saying 300 is what you get as net profit. Now when you start with net profit, it makes two assumptions. One is all sales are received, the other is all expenses paid, right? If all sales are received, this is an inflow. If all expenses are paid, this is an outflow. We've already assumed this has happened. Now we start with the net profit. The first thing we do is we adjust for the non-cash transactions. What do you see as non-cash transaction? Depreciation or amortization is the non-cash transaction. So you add back the depreciation, correct? Now you assume that there are some other changes that are going to happen. So you're going to look at what's happening to the inflow in terms of sales, right? Now let's say all sales have not been received. This is not true in real life. It usually will not be true in real life, right? And all expenses paid is also not true in real life. So effectively you have paid some sales. You have received some of the sales but not received all the sales. How can you find what is not received? What sales not received? How do I find this? I have receivables last year and I have receivables current year or this year. The difference of these two should tell me. If last year receivables was 100 and this year receivables is 120, then effectively 20 is the increase in receivables. Last year was 100, this year is 120. So increase in receivables is 20, which means 20 crore worth of sales has not come in, correct? Which means 20 crore worth of sales has not been realized. But when we started with the net profit was sales minus costs. It assumed that all sales have been realized. So this 20 has not come in. You have to subtract this because we have already assumed it is included in the net profit, correct? So we have to subtract this 20 now. So what are we subtracting? We are subtracting 20, or in other words, we are subtracting an increase in receivables. We are subtracting an increase in receivables. If receivables have increased, that basically means that you have not received that money that you were supposed to receive. And you have already assumed when you started with net profit that all money has been received. So now you are saying that that money has not been received. So you are going to adjust the net profit to subtract the increase in receivables, correct? Take a look at what do you do with payables. Now let's say payables were 50 last year and they are 60 this year, correct? Now let's assume payables were 50 last year and 60 this year. When you look at this, payables or increase in payables is 10. Now that means 10 crore worth of stuff that was supposed to be paid has actually not been paid, right? 10 crore worth of stuff that was supposed to be paid has actually not been paid, and consequently this is available in your bank account, right? So you have already assumed that all costs have been or all expenses have been paid, but now you realize 10 crore was not paid, so this must be still in your bank account. When you start with net profit, you have assumed it's gone out, but now you have to add it back. So increase in payables will get added back. Similarly, if a customer gives you advances, that's a current liability. So increase in any current liability gets added, those cash balances come in, and any increase in any current assets, prepaid expenses is a current asset. If you increase it, that's an outflow. So that's subtracted from the net profit, right? Then you make changes for any capital expenditure and you make changes for any debt that has happened, right? Debt coming in, debt going out, essentially. So you make changes for debt payment and you then take an addition to debt raised. And in case something is left after this, you also pay out the dividend number, right? The crux is in understanding these line items. Remember, all current assets increasing will mean that cash flows go down. That's because this is money that you had assumed has come in but has not come in, or money that you had assumed has not gone out in the case of prepaid expenses but has gone out, right? If current liabilities go up, you are basically saying that I had assumed this money had been paid, but that's not been paid as yet, right? So effectively, what that does is it results in your current liabilities increasing, also reflecting an increase in your cash flow, right? So let's summarize. You have net profit plus depreciation. What I will do is I will probably put this elsewhere. When you look at these items, increase in inventory, increase in receivables, increase in other current assets, increase in payables, increase in other current liabilities. So any increase in current assets is subtracted. Any increase in payables is or current liabilities is added, right? So what you are saying is minus increase in current assets plus increase in current liabilities, right? Now, increase in current assets and increase in current liabilities will basically mean increase in net working capital of the company, right? And you subtract that. So you can add up all this and say minus increase or change in net working capital. That's subtracted, remember, right? All these portions and net profit plus depreciation put together will give you your cash flow from operating activities. All that you see here is cash flow from financing activities, and capital expenditure or any other investments that you have done will give you cash flow from investing activities. What do we mean by net capital expenditure? Net capital expenditure will mean any capex minus any asset sale. Asset sale will raise money. Capital expenditure, which is buying of assets, is going to reduce your money. So this is your net number. Similarly, you can say increase in debt and repayment of debt as net debt raised, and then any dividends get paid out. That gives you cash flow for the year. Most of the times you have plus beginning cash flow, cash balances will give you ending cash balances. This number goes and sits in your balance sheet, right? This number goes and sits in your balance sheet and effectively balances everything when you're kind of linking these statements together, right? So that is how you basically calculate the numbers based on indirect method. Let's look at a sample cash flow statement, right? Now, in accounting terms, there are some nuances and some rules that you need to understand. That, for example, net profit is basically after interest, any interest expenses, but interest is treated as a cash flow from financing activity, interest paid, right? So what you do in real life is you also add interest here, and then you subtract interest again from the financing activities. So it's a plus minus activity. You are adding one thing and subtracting it again. That just gives you an idea that you just want to find out operational cash flows separately and financial cash flows separately. We will look at some of these items as well. Let's look at a sample cash flow. So when you get a profit, these guys start with profit before tax, right? We'll put the tax number in as well. There is a tax number here. Technically, direct tax is paid, right? Now, when you start with profit before tax, you first add non-cash expenses. And then I'm just going to quickly write where are your some of the items that are going to come. This is going to come in terms of investing activity, profit on sale of fixed assets. So you will add it here and then you will subtract it there, or you'll subtract it here and add it there, right? So fixed assets discarded, you first add it and then subtract it there, right? This is going to be financing, rent income, depending on where you classify. For example, so loss on sale of, sorry, this is dividend. So dividend on investment is investing activity. Rent income, investing. Loss on sale of fixed assets, investing activity. So you first put all these data points. You also see finance costs, right? Interest income, correct? These are your financing activities. So you first add it here and then subtract it elsewhere, right? So for example, here you are adjusting all these, you're either subtracting it or adding it, or depending on that, right? All the bracketed numbers look like subtraction, and then you end up adding all those numbers there, right? So for example, you will see dividends on unquoted non-trade investments minus 1.83. In cash flow from investing activities, you see a plus 1.83 dividend on non-trade current investments, right? So unquoted current investments. So you so you see zero point 0.6 here, you will see a minus 0.06 here, right? Sorry, these are slightly different. Sometimes these may not match exactly. That's because of accounting, entries that keep coming in and going out. But in general, you will see that these guys have done in terms of capex. This is your broad capex. Rest of these are adjustments that have come. Earlier, you adjusted on the other side in the cash flow from operating activities. Now you're putting them in investing. Similarly, you will see financing activities, increase, decrease in any kind of borrowing, short-term borrowings, and then interest paid, which is going to come here. And you will note that the finance cost 1.41 first got added here and then got subtracted from here, just to classify it as a financing activity. So that's how you basically create a sample cash flow. At the end, you get, this is A, net cash flow from operating activities, and you see the changes in working capital, adjustments for increase in operating assets. So inventory increase is an outflow. Cash went out, has not been realized in terms of sales as yet. Trade receivables increase is an outflow. That's all negative. Adjustments for increase, decrease in operating liability. So you see increase sees a bracket, which means increase in current asset is basically subtracted. Here, decrease sees a bracket, which means increase in current liability gets added. Remember this when you're building a cash flow. That's basically how you go about building a sample cash flow statement. We can look at a global one as well. So global one, this is the sample cash flow for Apple computers. They start with cash and cash equivalents at the beginning of the year. All the operating activity, you start with net income, then you go to depreciation, etc. You add non-cash data, then you look at the changes in operating assets and liabilities, changes in account receivable, inventory, etc. And then you get to your cash generated by operating activities. At this stage, we do not need to really know each and every line item that is there. That's okay. We'll learn as we go along. Then you have your investing activities, and then you have your financing activities. Any kind of increase, decrease in cash and cash equivalents. This is your closing cash balance. Even in the previous one, you had cash at the beginning of the period, which is this number, cash flow during the period, which is this number. Combine the two, you get ending cash balance, right? That's how you basically arrive at the overall sample cash flow statements that we are looking. So that brings us to an end of this particular section. Let's have a couple of quick questions around it. What is the difference between the direct and indirect cash flow creation methods? And explain the treatment of increase in current assets in the cash flow. Let's assume receivables have increased. What would be the impact on the cash flow? Negative or positive, and why? Thank you.